This week has been nothing short of fireworks in the stock market. We have Starbucks down double digits. We have CVS as well down double digits after reporting their earnings, both which we've just recently reviewed on the channel. Today we are looking at a company that has been absolutely hammered, a once dividend king, down 25% just today after their earnings, and they have released some very, very bad news for investors. As we can see here, they have cut their dividend. Not only have they cut it, they have reduced it by negative 89%. Now, we're going to take a look at this company in today's episode. It was a dividend king. We're going to analyze it. We're going to look at their top line revenue growth, their bottom line net income, as well as the health of the company, their cash versus their debt. We want to understand, is this company that now offers a yield of 1.5%, one that we can get behind for extreme undervaluation? As we have seen over the last year, they are down over 50%. We're also going to take a look at exactly how their earnings was, the reason for the drop. We're going to dive into essentially their investor slide presentation, see what nuggets of information we can pull out, what is useful for the future of this company. And as always, we will run them through the valuation model, getting to our intrinsic value, what is our acceptable buy price, incorporating our investor margin of safety, and we'll look towards Wall Street to see, after this massive dividend cut, is this a strong undervalued buy or one we should simply steer clear of? So first, let's discuss their historical performance. Now, we do know they do currently trade towards the lower end of the 52-week range. We also note that they are down 57% over the last 12 months. And if you've been a long-term shareholder, you would have seen nothing but pure pain over the last 10 years, down nearly 60%, and if you were to include dividends reinvested, you would still be down on your position. So not the greatest. We do note all-time highs. We can see around $57.53, and we are talking now around 3 years ago today. So let's understand what is going on, why this company has failed miserably, and we do know we have 1 sell rating as well as 2 hold ratings from Wall Street and Seeking Alpha. Now, we do note before the dividend cut, it was sitting around 10.18%. However, now, as we mentioned, it has been cut, and we can see by 89%, taking the dividend now down to 5 cents. So forward yield 1.1%, a lot lower, unfortunately, than the double digits that we have seen not too long ago. In terms of their earnings, how have they performed? Well, unfortunately, they missed on the earnings per share. 23 cents was reported. We see analysts were targeting 25 cents per share. On top of that, a year ago today, they had reported 39 cents. So we can see not just a miss, but also below the previous year, same quarter. When we take a look at their revenue, we can also see they missed posting 1.1 billion for the quarter ended March 24. When we do look in comparison to a year ago, it was 1.21 billion, and they did miss, although marginally 1.53%. So they've missed on the earnings per share, lower than the previous year. They've missed on the revenue, lower than the previous year. And they have also had a humongous negative 89% dividend cut. So the question is there any real value left in this company, or has the market overreacted and now could be a great time to buy after the cut? Now, in terms of the growth year on year, we do want to see a minimum 3 to 7% as a baseline. What we have note, just purely looking on a graphical basis, very minimal growth over the longer term and fairly inconsistent. When we take a look at it numerically, it has gone from 3.8 billion in 2014 to 4.7 in the more recent year. But we also note it has been declining. In fact, from 2022, where we did see the highest sales figure at 5.1 billion, it has come down considerably, and it is very inconsistent. As we can see, it does increase and then decrease, and it does follow a similar pattern throughout the last 10 years. In terms of the bottom line net income, what can we gauge? Well, it's gone from 98 million in 2014 to, as we can see here, a loss posted in December 2023. And again, the inconsistency does continue. Unfortunately, we haven't noted increasing revenues as well as increasing bottom line net income. So that is a red flag indicator already to start off the episode. In terms of the health of the company, total cash versus their total debt. Well, they have 333 million of cash in December 2014, a little bit more in their latest quarterly report, 361 million, and we do note fairly inconsistent over the last 10 years. Now, as always, that's not a red flag indicator purely on its own, but when we compare it to their total debt numerically and directionally, we can see their cash balance, whilst it has pretty much remained flat, their total debt has gone from just under 1 billion to 2.3 in their latest quarterly report. And as we can see, the trend over the longer term has been increasing. Now, that is a bit of a worry. We can understand when we do take a look purely at the dividend safety at 30, why it did look to be unsafe, and why maybe we are seeing some reasons for this dividend cut, but we will explore that later on. In terms of their earnings, well, not really great if you are looking. I mean, purely in 2023, they missed every single indicator on earnings per share. They missed in Q2, Q3, as well as Q4 and Q1. And we can see even for the next full quarter of 2024, they are expecting it to be lower than year on year. So negative 18%, quarter 3, negative 10%, no real growth until quarter 4. Something to consider. Again, factor this into your investment thesis, factor this into your investor margin of safety, but we can see a lot of negatives with trends, patterns, and just performance for LEG so far. We can see the valuation grade an A+, but when we compare it to essentially the sector on a forward PE gap basis, 16.58, it is slightly higher than the sector median, although this does need to update, it is slightly lower now, but generally we can see the metrics aren't too far off the sector median on any type of valuation basis. Now, for me, I wouldn't say this is great due to the fact that, as we can see, they have missed on their top line, they've missed on their bottom line, and essentially we can see that massive dividend cut. Again, the information is there though, so you can come up with your own conclusions. When we look on the growth grade, they get a D- year on year, negative growth. Forget about what the sector does, just negative on its own is very poor. Negative on a forward basis expected, and this is a similar theme across all of the valuations, so that is never a good sign. So we understand it may have had essentially an A on the valuation, but if the growth is looking like a D-, again, something to bear in mind. Profitability, C, but remember those two things that I do quite like to look at. The gross margin significantly lower than the sector median at 36%, with LEG at 18%. When we look at the bottom line, negative 3%, with the sector at 4.5%. So lots of things that you really do need to consider. Obviously, we also note the positives that their cash from operations was significantly better than the sector median. We then take a look at how they compare against others in the industry. Now we're talking about Lazy Boy Incorporated, Ethan Allen, and a few others. Now over the last year, so total return, remember, including dividends reinvested, they are down a massive negative 54%. That is, for example, if you were to invest $1,000 into this company a year ago, right now you would be sitting at under $500. When we expand that to over the last 5 years, again, very poor performance, negative 56%. We do note, though, that some others in the industry are also negative, so you could put some of this to just the economy in terms of this industry-specific companies. And when we expand it over the last 10 years, again, the worst performing, negative 41%. So if you had essentially a $1,000 investment in this company 10 years ago and you were reinvesting all of those high dividends, right now you would be sitting around only $600. So not great at all. Again, I do want to say that past performance is an indicator of future performance, but just bear in mind this company doesn't have a lot going for it at the moment based on the reviews that we are doing. In terms of insider ownership, well, just under 2%, just one insider selling noted of just under $200,000, and we can see that this was essentially in Q2 of 2023, so relatively little movement in the more recent period. We have to go back to the 23rd of May, so nearly a year ago, to see the director sell around 6,000 shares at an average price that is significantly higher than the current trading price of just under $200,000. Not real much that we would say to include, given the fact that it is fairly historic. We then move on to the institutional ownership. Now we see 64% of institutionals ownerships, and then when we take a look at the outflows, 238 million. Interestingly, we do note a little bit more buying than selling over the last 12 months, and that is something that is also essentially seen here in Q1, 4.11 million worth of buys versus 2.76 million worth of sales, the opposite that we see in Q4. So Yes, overall with LEG, institutions are buying more as well as in the more recent period, and we don't really note much relevancy right now over the last 12 months in terms of insider movement. Again, always do your own research, but this is just some of the trends that we are noting. So let's look at their essential investor presentation. What can we take away from this in terms of the company, in terms of the future, as well as their historical performance? First thing to note, their reported Q1 performance versus Q1 2023, how that has been. Well, as we can see, just over 1 billion reported. In the same quarter last year, it was higher. In fact, it has been a 10% decrease. In terms of EBIT, so the earnings before interest and tax, it is down 29%. EBIT margin down 160 BPS. When we look at the earnings per share, again, down 41% versus the comparative data. Cash from operations, in fact, it was positive 97 million. Now it is negative 6 million. And both EBITDA as well as the EBIT margin looking worse off in Q1 24 versus Q1 23, as we can clearly see in the movement. So not great, unfortunately. There isn't much that we can really put a positive spin on this, but you have the information here so you can come up with your own conclusion. Now, what I wanted to point out when we do take a look at their sales and guidance moving forwards, their sales moving forwards, as we can see for 2024, is expected to be down around 2 to 8% versus 2023. So not great at all. We're talking about a company now that when we did take a look at it on a revenue basis, it was very inconsistent and it is expected to continue to be inconsistent. We're not talking about up 2 to 8%. We are talking about a decrease of 2 to 8%. And we can also see their earnings per share as well as their adjusted earnings per share to be lower than the previous year. So do take these all into consideration. Again, this isn't to say this is a bad investment. It isn't to say it's a good investment, but information is there, clear, and you can come up with your own investment thesis. Now, finally, what I thought was very interesting when I did go through their investor slide, not something that essentially they have pointed out, which I think is a little bit interesting, but we don't see anywhere where they have said this dividend cut. We have had to take a look at other articles. The only thing they do mention here is that the dividend expenditure is meant to be around 135 million versus the prior year guidance of 245. Clearly, it is going to be a lot lower because of the dividend cut, but unless you were to look at other articles, maybe it wouldn't be something you could easily pick up. Anyway, we have pointed out just to let you know. And before we take a look at their financial metrics, we just want to let you know we have released our latest free weekly article. If you want to gain access to this or any others, all completely free, do click on the pinned comment below. And I would advise taking a look at this article, How to Find Undervalued Stocks, as this is where we explain all the websites we use on our channel to value stocks as well as to analyze them. It is something that is always asked in the comments below. So dividend safety score, yes, we get a 30 unsafe, but bear in mind now after the dividend cut, this should turn to something that shows a bit more safety, given that negative 89% that we did just see yesterday. So the new dividend yield is sitting at 1.5%. The market cap is 2.42 billion. They are a mid-cap company. Now look, they did reaffirm their essential unsafe score of 30, and as we can see, they have a moderate to high risk of a dividend cut, and that's exactly what we have seen. Unfortunately for investors who were enjoying and using that 10% dividend for their expenses or just to reinvest into companies or other companies. Key metrics then, last recession, while they increased the dividend during the 07-09 crash, they had below average growth, negative 25% versus the S&P, which had negative 12, but they did marginally outperform, negative 44, as we can see the S&P itself, negative 55. Unfortunately, negative 89%, that was the dividend cut. We have mentioned it. Last 5 years and last 20 years, it does feel irrelevant to talk about given the fact that we see this massive dividend cut, but the information is there. And we can see they will no longer be a dividend king. They now reset to zero with 0 years of consecutive increases. And when we do take a look at dividend yield theory, it won't be something that we can use in today's episode given the fact that we see the massive cut, but typically if we see the yield above the 5-year average, it is an undervaluation signal. We do, however, note the forward P sits much lower than the 5-year, so 11.1 versus 16.7, and we also note it is marginally lower than consumer discretionary sector P of 13.5. But as always, we never look at any of these models in isolation, and we will conclude towards the end. Free cash flow payout, that is something we focus on, and it is something that we always say choose rather than the earnings, as it is susceptible to manipulation by management through accounting and will show you signs of any potential dividend cuts. Now, below 60%, always the blanket rule, so we have faith of those double-digit dividend increases. Now, last 3 years have been fairly high, 137%, 69, 65. Now, no surprises, the next 12 months is expected to be around 12%, given the fact that massive dividend cut. So no worries with this new dividend yield of 1.5% or 1.1 on a forward-looking basis. Free cash flow, as always, I would recommend looking or investing in companies with increasing free cash flows year on year. Yes, it has increased from 2014 to 2023, but two things to note. One, the inconsistency. The second, the fact in 2024, it is expected to come down significantly as well. Another red flag indicator, or what I would consider to be one. In terms of sales growth, 3 to 7%, remember that is really what you want purely as a baseline. What we know, very inconsistent, 3 of the last 10 years negative, and unfortunately the more recent negative year being the current FY23. So numerically we can see just another format but very minimal growth. If you factor in inflation, it probably has barely increased in real terms. And what they have done very marginally, we do like to say returning excess cash to investor pockets, but we can see it is very marginal. And in fact, from 23 to 24, they did issue some shares. Net position, though, we do see share buybacks, very trivial, so we won't discuss much on that. ROIC, now I want to see 10% or more to give me faith that management are able to effectively allocate their capital. What we can see, it has been pretty strong over the longer term, but a red flag indicator is the fact that it is decreasing. 9% in 2023, trailing 12 month at 8%. It does look like it will be getting lower and lower. Now, I will give my thoughts, but as you can see, given what we have run through in the metrics, my essential conclusion should be very clear. Operating margin, then we do see it above 12%, the preference, and it has been decreasing. That is operational inefficiency, another red flag indicator. 6% on a trailing 12-month basis as well, so we do expect FY24 to be lower. Interestingly, though, they have free cash flow margin above the 5% minimum for the majority of the last 10 years. Finally, we look at the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization. This is extremely important because it does correlate to dividend safety as well as balance sheet strength. And what we can see are the number of years it would take the company to pay off all of their debt net of cash on hand. 3.04, so just straddling above that in FY23, 3.65 in FY24, so going even higher. Something just to consider, even after the dividend cut, their essential debt levels are fairly high, something we did mention when looking at that balance sheet review. Now let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically we do run through all 4 models, but the only one that is really relevant with this company is the discounted cash flow model, and there is a lot of subjectivity around this. So we have the free cash flow year on year. We can see the average growth rate does sit just over 18%. On a forward-looking basis, we've gone for negative 6%. It is expected to decrease, but this could be anything really depending on what you believe moving forwards. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we do get an undervaluation signal, and we will put this through the margin of safety element shortly as well. The only thing we do want to say is it really depends on the growth rate. If over the longer term you actually think no, it will be 0%, the price does go up to around $33. If you think no, it will be more than -6 and it'll be -10%, then we can see, in fact, it does look overvalued currently. So it really does come down to the subjectivity around the growth rate, what you believe. And as always, you can grab a copy of this model to run your own numbers through, whether it's for LEG, other companies in your portfolio, or those in your watch list. So typically you would do the average of these 4 to get to the intrinsic model. But what we can see is the value is coming to 1637. And we will run our margin of safety, which, as always, we want 10% as a bare minimum. We use that if it meets the 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Now, for LEG, again, it does depend what you believe for this company, but we keep going till it's near the current trading price, and we see estimates and our judgments giving this around a 20% MOS level. Now, what about Wall Street in terms of their price? Well, they see a price around $17 over the next 12 months. As we can see, upside of 33%. But as always, given the fact that they have had a dividend cut, a lot of investors who were holding this purely for the double-digit dividends will look to sell. then I'm interested to hear your thoughts. Maybe after the dividend cut, you actually see this as a value play. Maybe this is one on your watch list, or for whatever reason, it isn't one you're looking to add. Now, hopefully we've made it clear throughout the episode, but there are a ton of red flag indicators. This is definitely one that we will not be touching, not investing at this point or any time in the future. So many red flags, there isn't any point in concluding or summarizing, as nearly every single thing we reviewed did show some signs of worries. However, as always, do let us know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.